Hey there. We're going over Interbank Price Delivery Algorithm. Now, the Interbank Price Delivery Algorithm, okay, or in other words, quarterly shifts, okay, you've probably heard this term a lot. Some people teach it in a confusing way, some people teach it in a simple way. Most people teach it in a confusing way. We're going over how to use it, and I'm going to teach you it the simple way, okay? Now, the quarterly shifts or the interbank price delivery algorithm ranges need to be used on higher time frame charts. Higher time frame charts as in daily, weekly, and monthly, but for this specifically the daily because it's based off 20-day, 40-day, and 60-day ranges. So here we are on the daily. Well, should I delete my drawings? Sure, I'll delete them. My drawings are now gone. So for example, here we are now. If we go to the now, today is the Monday, the 30th of December, okay, 2024. First thing, if you want to draw your interbank price delivery data ranges, is you have to look at the current date, okay? Current date is 29th, okay? So what you would do is really focus on the month, okay? You really won't focus on the month that you're in, which is December. So what you would do, since we're in December, you would go to the first of the previous month. So the 1st of November, which is right about here. So the 1st of November, right there, you want to put a vertical line on your chart because that's where you're going to begin your analysis, okay? So we have two things. We have the look back, which is where we draw a line backwards, 20, 40, and 60 days. So we got the look back, and then we have the cast forward, okay? First, we're going to be going over the look back. What the look back is, the purpose of the look back, okay, is during this time, you want to look for where the previous market structure shift occurred, okay? Now, first, let me pull out my info. You'll learn more in just a second. So if we go all the way from here, and then we go to 60 day, okay? You go 60, and then I can do maybe 40 here, and then 20 here. So looking here, okay, you want to, but casting back, you want to look for PD arrays that price can trade into, and then you want to look for when the last shift occurred, okay? Like which range did the, last shift occur, okay? So looking here, just right in this area, we can see that looking in 20-day, we can see that price was clearly bearish. Institutional order flow was bearish. So that's the first thing you want to identify. Is for each range starting from 20, 40, and 60s, you want to identify the institutional order flow. Okay. So in the 20-day range, bearish. 40-day range, we had a little consolidation here, and then bearish. Then the 60-day range, we had more consolidation, and then leading into the 40 and 20-day look back range, we were dropping. So I confidently say that the shift occurred in 60-day, okay? 60-day right here in this range. So we can delete the 40-day and 20-day. So what this means is, okay, since we had a shift 60 days ago, we should expect the next shift to be right here on November 1st. Why? Because it's quarterly shifts. Quarterly, there's 4 quarters, okay? So if I draw 4 quarters, 1, 2, 3, 4, okay? Each quarter is what? You need how many quarters to make $1? 25, 50, 75, $1, okay? How many months are in a year, okay? There's 12 months. Divide those 12 months into 4 quarters, okay? You will get 3 months 4 times. So 3 months, 6 months, 9 months, and 12 months. That's what makes up a whole year. So since we're starting from November, right? From here to here, that's 60 days. So for example, if we had our line here, even though we're not doing our analysis right now, but for example, if it was here, from here to that point where we do our analysis, that's 60 days, okay? Because it's a shift every 60 days. So if we shift back here 60 days ago, we should expect the next shift to be right here on our vertical line, right? Very simple, very simple. Okay, that's basically the cast forward. I just explained the cast forward, okay? The cast forward is basically when you would expect your next shift, okay? So if your last shift was 60 days ago, you don't have to cast forward because your shift will literally be around your point of analysis or where you begin your analysis, which is November 1st, according to where we are now. But you may be looking at this at, I don't know, August or April or October or January, okay? For example, if we were in January, where you would go, you see, if we were in January, which is right around here, if you were in January, you would go to what? The 1st of December, which is right here. If we can get to it, there you go. You would go right here to 1st of December, right there. Then you would look back 20 days. Oh, wrong one. You would look back 20 days, 40 days, 60 days. Now, then, like I said, you look for the institutional order flow and the PD arrays that price can trade into within these ranges here. So 20-day price is heading higher. First, we identify institutional order flow. During 20-day range, we're heading higher. 40-day range, we're heading higher. Then 60-day range, we can see that right in the 60-day range, or right when that 60-day range, we look back, we can see if we draw a box from here to here, okay, we pull it up, you can see that that box from here, it comes right into the 60-day range. If I drag it a little below it, you can see that the box is right in the 60-day range. It goes outside of the 40 and outside of the 20. So what that means is we should expect our next shift when? Right there on December 1st. Did we shift? We did. We did shift. But what did we do afterwards? We kept consolidating. We consolidate. But if the shift is right here, okay, understand this. If the shift is right here at this high, so we came up, shifted, dropped back down into a rejection block and a order block, actually right here too. We drop back down into a rejection block and a order block. And is that a fair value gap? No, that's not. But we did drop back into a rejection block and an order block, okay? So if price shifted, you'd expect the next shift to be right here on December 1st. It shifted and went lower. Why did it go lower? Because we just previously identified that institutional order flow was bullish. What did it come to? We look here, fair value gap, came to a fair value gap. Then it came to an order block. What did it? Yep, it came to an order block right here too. So this is what the purple box should really be right here. See, look at that, very institutionally precise. See that? That's the order block. And then this here would be the fair value gap. So we came into an order block and a fair value gap, okay? Did we come into a mitigation? Yep, right there. We came into a mitigation right along there. Look at that. Very, very cool, okay? And then we continued the previous, institutional order flow, the previous 60 days of institutional order flow being bullish, okay? Now, if we go back to our current example where we were looking, okay, which is right here, we identified with this example from the November 1st analyzation that the last market structure shift occurred in the 60-day range. Okay, so we were expecting the next shift or continuation of this shift to be in November 1st. Okay, right at the when the shift began, we shifted higher and traded into what? What did we trade into, huh? Are you looking? Traded right there into that volume imbalance. See that? Right there. Right there. And I will warn you, if you're watching this now, you guys at this point, this video might be just a little long. It traded right into that volume imbalance, then continued. See that? Absolutely crazy. Isn't that cool? Very, 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 very cool. So now we're gonna go over another example. Let's see. which month? Let's do July. 1st of July. Okay. So right here, right there, that's our vertical line. 1st of July. What we do is you first look back 20 days. I keep picking the wrong line. Why do I keep doing that? Am I a little autistic? It might be. But 20-day, 40-day, and 60-day. Okay. As you know, every month of trading, or every trading month, consists of 20 days. And it takes how many quarters to make a single dollar? It takes 4 quarters, okay? So this is 1 month, that's 2 months, that's 3 months, okay? So it takes 4 60-day intervals or 60 trading days. It takes 4 60 trading day intervals to create a full trading year, okay? So it takes 4 of these 60 days to create a whole year, which is why we use the 60-day, or aka 3 month, to determine when's the next quarterly shift, because it's literally a quarter of a year. These happen 4 times every year. So looking back here, you see in 20-day, institutional order flow is bearish. We can see in the 40-day that institutional order flow is bearish. And then we can see in the 60-day is that there was some sort of market structure shift. Okay. Some sort of shift or heading higher. Okay. Now let's look here. For the 40 and 20-day, we were retracing lower. Into what exactly? What exactly were we retracing lower into, JJ? Well, let's look. Let's really look here. There's barely any PD rates, but we can keep looking. So first things first is we came down into this point of sell-side liquidity here. So that's sell-side liquidity purge. And then we left this high here. Right there, that's buy-side liquidity. So price came down into sell-side, returning back into this order block once again. You know, it bounced off of it here. Then it had one more tap into it. Did it break through it? Barely. Let's see, did it break through it? Nope. So that order block is still valid. We came back into that order block right along here. We can draw this out. How do you do it? I'll do it right here. So we came into sell-side liquidity, and then hit the order block, okay? That's a PD array that we can look for, or that's a PD array that we have now searched for that price has hit within the 20-day range, okay? So 20 and 40-day range was bearish, okay? And I guess you could say the last shift, okay? The last shift really was in 40-day, okay? So it's in 40-day. So since it's in 40-day, we would expect the next shift to be 20 days forward from here, somewhere around here. We want to see the next shift be right there. Did it shift within 20-day range from here? Yep. Because look, after this point here, what do we start doing? We start hitting higher. Pretty cool. Pretty cool, isn't it? Very, 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 very cool. So 60-day institutional order flow was mostly bullish, and then we had a retracement. 40-day bearish. 20-day right here, or if I can drag this one lower. 20-day bearish. Okay. Why are we bearish? What are we coming into? Okay. So if we know that the institutional order flow was overall bearish for this quarter of the year, what do we want to expect for the next quarterly shift? We would expect it to be bullish. Okay. How does this prove our point? Price comes into an order block and then comes into sell side liquidity and then re-injects those orders back into the market with a liquidity injection. Pretty cool, right? Very, very cool. So the shift occurs right around in this area, probably like around here somewhere, but it does occur in the 20-day range because we can see as soon as, you know, we go to, it's within 20 days, not exactly 20 days, but as we can see within this range here, this line right here, within the candles within this line, it did shift higher. Did it? It did. Okay. So now we can go back. Let's delete all these drawings. We can go back to maybe February. Let's go to February. Actually, no, let's go to March. So let's delete this too before we, continue. Before we continue. Now, with this one, we're going to be using the DXY or the dollar index. Maybe I might teach. Yeah, I'll teach you relative strength analysis in the next one. Okay? That's in the next video because that's going to be that's going to help you identify institutional order flow and what price really wants to do. Okay, we use the DXY as our benchmark. Okay, or that's in ICT terms, but in reality, we use the dollar index for analysis, and then whatever we're trading is called underlying. So dollar index is our benchmark, and then whatever we're trading is the underlying. Okay, so in this case, dollar index is the benchmark, then euro dollar is the what? Is underlying, or what we're trading. Okay. Now, starting here, what was it? March 1st? Let's see here. March, where is it? March 1st. I got it, guys. I wasn't retarded this time. Now, what do we do first? We go one. Oh, wrong line again. Yo, I might actually be a little retarded. Like, seriously. 1 is 20. 2 is 40. 3, that's 60. Okay. Now, clearly, through all this, what happens? What is going on here? We can see that institutional order flow is clearly bearish. Okay, it's clearly bearish. Was there really a shift here? No, there wasn't. There was no shift. It was just bearish institutional order flow. Okay, but if we look within the 20-day range, we can see that price shifted higher. Okay, now since price shifted higher in a 20-day range, we want to cast forward 40 days. Oh, wrong line again. We want to cast forward 40 days right here. Okay, price should what? What should price do in this area? It should shift lower. Does it do it? Yep. Now let's look at the anatomy of this. Let's look at why we shifted higher. Okay, let's look at why we were bearish. Okay, this bearishness created a what? Market structure shift right there at that low. You might be like, at that low? Yep, at that low. Because on a weekly, it'll look like a perfect market structure shift, but on a daily, it may look nasty. But this is still a market structure shift. Okay, this is still a market structure shift. We're not using any relative strength analysis like using the dollar index. We're just using strictly euro dollar. Okay. If we break in market structure, price retraces higher into what? JJ, what is it? What does it retrace into? Do you remember optimal trade entry? Yep, look at that. Trade into optimal trade entry. Retrace into this order block here and this rejection block. Well, really, this order block got ran through because it came in right here. Then it, created a market structure shift. But we came into this rejection block here, then drop lower, coming into this optimal trade entry too. Then what else did we do? Liquidity. That liquidity purge. Or you can say, yeah, liquidity purge. There we go. A liquidity purge. So we should expect the next shift to occur when? In 40-day range. And what should it do? Okay, what should it do? It should be bearish because why? We shifted higher. Okay, we shifted higher during what? The 20-day range. Okay, so basically, whatever you look back and cast forward to, it has to equal 60 days. And what do I mean by that? If the market structure shift or the quarterly shift or whenever you see an obvious shift in a market, and for example, it occurs like here, it occurs in the 20-day range, you want to cast forward 40-day range to look for the next quarterly shift to occur. If it occurs in the 40-day range, looking back, you want to cast forward 20 days because it was 40 plus 20, 60. Then if it occurs in the 60-day range, how much do you want to cast forward? You don't want to cast forward none. You just go straight to your point of origin or your start of analysis, which is March 1st. Okay? Because what's 60 plus 0? It's 60. Literally 60. You're adding nothing to value. It's still 60. Okay? So, did price shift? Yep. Shifted lower. Came into a high. We retraced into a what? Into a what? What did we come into? Let's see, JJ. What did we come into, huh? Oh my god, he's whipping out the fib. Wait a second. Wait. Oh my god, we came into a premium, guys. Oh my goodness. Guys, we came into a premium. Oh my goodness, we came into a premium. But with all seriousness, we came into a premium, took out a high, okay, and then we dropped lower. Now, looking into this area here, the 40-day range, let's look here. This is where we look to plan our long-term setup, okay? You can use this in short-term analysis, but this is mainly used for trades. I'm not saying you can't use this for short-term analysis, okay? You can get a long-term price for your short-term trades, okay? You can use this. But this is for the ones that want to use this for like long-term and all that. But we have a market structure shift right there. Got that market structure shift. See that right there? Break the structure. Very cool, isn't it? Very, very cool. Come below. Come up. There's an order block. One more tap into it right there. You take out this high here also. See that? That high right there. What is that? I think it's called a liquidity purge. Yeah, I think that's what it's called. It's called a liquidity purge. And we also come into a mitigation too, right here. Okay. What price will do is it'll first come to the mitigation or look to reject off of the mitigation before it comes into the order block. Okay. And there's a mitigation and an order block here, basically. Well, no, actually, wait a second. This would theoretically be a breaker because we came above this high right here. Because with a breaker, it must break a high and then, break lower. So technically, this would be your breaker, right? Wait a second. Wait, am I getting myself confused? Wait a second. Yeah, that's your breaker, exactly. So, yeah, that's your breaker. right there. And then price heads up, whoop, into the breaker. It's right here. It's your breaker right there. Then price already used it once. As you see here, price came up, used it, so that's out of the picture. Price already used it to go lower. So then we will ignore that and look for this order block since that breaker block's out the way. Okay. So we use this order block for reference since it already used it right here in this little retracement up. So you could look for your entry here at this what? At this order block. And if we look, did it respect the mean threshold? Yep, it did. Respect mean threshold. See that? It didn't break through it. So once you see that, you probably drop down to like an hour or 30-minute or something like that if you're a short-term trader and look for an entry. Or if you're a long-term trader, you literally get in right here once we start seeing resistance off of it. Boom. Okay. But now we're gonna go to another one because I need you to get a good, very, very good understanding of this. I might do a second version of this video just to clarify some more things because there's new stuff that I'm learning and then I have to reteach to you. So let's go to June 1st, wherever that is. June 1st, right there. Okay. First thing we do, look back 20 days, which is right about there, 20 days, then 40 days, then 60 days, if I can get to it, 59, whatever, 60 days, okay? That's it right there. Boom, bam, pop. Okay, we got it. Let's look here. Now, 20-day institutional order flow was clearly bearish. Okay. Then, 40-day, we had a slight consolidation, and then institutional order flow was clearly bearish. Okay. 60-day had a little slight curve up. Then, around here is when we entered the 40-day range, and then we shifted. Okay. So, looking here, where do we shift? Where do we have a major shift? Okay. Because 60-day range, it's just following, it's just continuing an already active, trend, okay, or an already trending trend, whatever you want to say. But in the 60-day range, there's no shift, okay. It first occurs in the 40-day, okay. It first occurs in the 40-day. So since it occurs in the 40-day, what do we want to do? We want to look for the next quarterly shift to occur when we want it to occur. We want it to occur 20 days, okay? Because 40 plus 20 is what? 60. So, why do I keep using the wrong line? Do you see this? I mean, I keep using the wrong line over and over again. Okay, there you go. 20 days, okay? Because what? The shift occurred 40-day. Why? Because we consolidated, shifted lower. See that? Pretty cool, isn't it? Very, very, very cool. Okay. Then as we see in this range, we shift higher. Whoop. Then we retrace lower into this fair value gap. And then that's your entry there. Because as you see, the bodies don't really go lower. They around here they do, because they keep taking out lows, purge. And you finally have that one explosive movement back up. Boom. See that? Very, very, very cool. Amazingly cool, isn't it? Now let's look at the PDAs and why all this happened. Okay. So we can see that there was a bullishness here, a lot of bullish order flow here. So what we're doing within this retracement, we're coming into a discount. Okay. Now, since we were coming to a discount, we're looking for discount arrays to push back into premium arrays. Okay. If you're bullish, and if you're bearish, you're looking for premium arrays to push back down into discount arrays. Okay. So looking for discount arrays. Why? Why are we looking for discount arrays? Okay. I'll explain why. Because this right here, the shift, we shifted into bearish institutional order flow. Okay. And if the next shift is in 20 days, what should that next shift do? It should shift into bullish order flow. Does it do that? Sure does. Does exactly that. I don't even have to say anything, but does it go higher? It does. It indeed goes higher. Okay. So looking below in this area here, in this little box, or I can draw a little range right here in this little area, we're looking for PD arrays. Okay. So we have a 1. See that? Volume imbalance. Okay. I will say something here. Whenever you see a volume imbalance get respected, that is a huge confluence, okay? Because volume imbalances are the weakest confluence. They are the weakest. They are the weakest, the weakest, the weakest. Okay? Do you understand that? You get it? Okay. I'm glad you do. I'm glad you did. And I'm sure you would have got it because you're super smart, aren't you? Very, very, very smart. We came into that volume imbalance right along there. That's our PD array. And that we really don't even need anything else because as we can see, price respected it. Once we see a volume imbalance get respected, I don't even think there's anything you need to look for because this is if it's the think about it. If it's the weakest confluence or weakest PD array, you see it get respected. What do you think that means to you? You think price is gonna run through it? Makes no sense. It's like basically in a boxing ring, if you got the weakest guy up against the biggest guy, and the weakest guy wins, you're still gonna think the weakest guy is trash. He just beat the biggest guy in the whole ring, or the biggest guy in the whole room. Like, come on. But with all seriousness, this is really all we need because as you can see in hindsight, you're like, oh, he's using hindsight. Oh, dang. Well, I'm using hindsight to teach you. So if you're acting like that behind a little screen of yours, then you're cooked. But we came into that volume imbalance. All right, we're looking for the next shift to be where? Within 20-day range. Why? Because the previous shift was within, it first occurred within the 40-day range. Okay? So 40-day range shifted market into bearish institutional order flow, causing the market to retrace into a discounted volume imbalance. And then we also reach into a discount at that. And then around this area, we should look for a shift. Okay? This creates the shift right here. This right here creates the shift. That volume imbalance right there, you want to zoom into it, and right there, volume imbalance, that was creates the shift. Why? Because we bounce off of it because it's the weakest confluence. And it's a huge confluence that it bounces off of it because it's the weakest confluence or the weakest PD array. I keep saying weakest confluence, but weakest PD array, and that's a huge confluence. That's what I'm supposed to say. And then that's where you should anticipate a shift. Okay, and is it shift? Yep. I can confirm it. It does shift. Do you think it shifts? I think so. I think it shifts. And then once you see that, what can you do in this situation? What can we do here, JJ? What do you think we can do? Well, first things first, is you got this rejection block right here. Where if I move this volume balance out the way, you got that rejection block right here, right in this area. We come below it, boom, there can be your entry. Or if you missed that, okay, take this order block right here. This down close candle right here, that's the order block. Or this one here, this would be your order block because it's the deepest candle before price heads higher. It's the deepest bearish candle before price is higher. So this will truly be your order block. Then we have a rejection block there if you miss that order block. And then we have another one if you miss that rejection block. It comes down into it, and then boom. Then we have another retracement again. And if you notice, you know what's crazy? You know what's funny, right? As soon as the 20-day range ends, what does price do? It starts consolidating. Isn't that crazy? It starts consolidating. That's wild to even think about that. That's insane. Truly wild. Okay, so we consolidate right here, and then we come lower to what fair value gap. Do we come to a discount of this range? It doesn't look like it. Not from eyeballing, it doesn't look like it. And then we continue higher. Boom. Okay. Now we're gonna move it forward. Move it forward. Let's delete this. We're gonna move it forward to, let's see, August. I guess I could do August. Let's do August 1st right here. So August 1st, it's my mom's birthday. August 1st. I said 1st. August 1st. Let's see here. Wait, let me go up here real quick. So we grab the line successfully. 20-day, right there. 40-day. 60-day. Boom. Okay, boom. See that? Like so. Boom. Okay, now let's look here. Looking back in this little area, let's look. So we can see 20-day was bearish. Okay. 20-day was bearish. Do we shift? Yeah. We shifted from this here. But the major shift, we're looking for the major shift. Okay. We caused a little, shift within 20-day range, but we're still looking. Okay. 40-day, institutional order flow was bearish. I mean, not bearish, but bullish. 60-day. Oh wow, look at that. We have a shift. So if we have a shift all the way from 60-day, okay. So let me explain this. Before I go any further, let me explain this, okay? If we have a shift in the 20-day, okay, and there's not a shift in the 60-day, you use the 20-day. But if there's a shift in the 20-day and there's a shift in the 60-day, refer to the 60-day. Okay. So basically, the larger time intervals are the stronger ones. Okay, those have more importance. So if you have a shift in the 40-day, for example, and you have another one in the 60-day, use that 60-day shift. Okay, because that's the true shift. Remember, it's quarterly shifts. Okay, just had to say that before everything went over your head. So if we see a shift 60 days ago, which is clear because if we do a vertical line right here, right there, we can see that after that point we went higher. So 60 days ago, if we had a shift 60 days ago, when do we expect the next shift? Right here on this line. Because why? From here to here is 60 days. So we expect a shift right here. If the shift occurred in the 40-day, we will want to see a shift occur in the next 20 days. If the shift occurred in the 20-day range, you would cast forward and look for a shift in the next 40 days. But in this case, since it's 60 days, we want to look for it in the next 0 days, or also known as now. There's a shift? Yes, sir. Yes, sir. Or yes, ma'am, if you're a female watching this. But yes, sir, and yes, ma'am. It did drop. Okay. Now let's look at this, shall we? Let's really look at this. Now, looking here, buy side liquidity right there. Okay, so price came up into buy side liquidity and ran through it. Now, since the previous shift was bullish, okay, since the previous shift had bullish institutional order flow, the next shift should obviously be bearish. Okay, so that means we're looking for premium PD arrays going down into discount arrays. Okay, or basically that means we're looking for bearish PD arrays that are in a premium, and then we're taking those PD arrays into bullish PD arrays that are in a discount. Okay, or bullish PD arrays are also known as discount arrays. Okay, so in this scenario, since we're looking for bearish institutional order flow, we'd be taking premium arrays into discount arrays. Okay, so that's all we're doing. Okay, so we're looking from this point forward. Now, let's delete this line, shall we? Well, I could have kept it there, but I don't really want to keep it there, to be honest. So it was on this candle, right? Or wherever August 1st is, right there. That's August 1st. So, looking here, is that a breaker? Oh, wow, that's a breaker. But that is a breaker right there. I would say this is a mitigation, but it's a breaker. Okay. So price comes into this fair value gap. That's one. We respect this fair value gap twice. Okay. And on this candle, we come deeper into it. So one tap, two tap, then we come into this breaker right here. If I can even select the rectangle, price comes up into the breaker like that. Boing, goes lower. Okay. So what is the last thing that we can use for reference here? Order block. Order block right there. Right there is your order block. Okay. Or even if you don't want to use that, well, in which it got used here. Okay. Well, you could have still used it because it didn't really displace away from it. Okay. If you don't see a PD array getting displaced away from, you can still use it. You can still expect price to retrace into that and respect it a couple times. Because if we're looking here, did price displace off of that order block like majorly as like a move like this, but downwards or bearishly? No. We came up into it, came up into it, came up into it again, and then we said we see, big difference. Now you can still use this order block. Okay, price comes up into it after that August 1st point. That's your entry right there. Bam, right there. Or if you're a short-term trader, you can use it as a confluence and then jump down to like the 15-30 minute during the kill zone and probably take the 9:30 open, or maybe like the 9:50 macro, and then that's your entry for the next couple of days bearishly. Okay, they use the hour or 4 hour to see where price wants to go before it goes lower. Okay, because price always has to retrace, rebalance, and do all that. It just needs to. It's common knowledge. So we come up into that order block right there. Do we respect any levels? Do we respect any institutional levels? And so let's whip out the quadrant, shall we? We respect the what? Lower quadrant. Okay, so if we respect the lower quadrant, that means we're expecting more PD arrays to form. Okay, we're expecting more PD arrays to form to add more positions. Okay, do we have more PD arrays form? Yep. What do we have? Breaker right there. order block right here. Then what else? Then we have immediate rebalance right there. So that would have been 2 positions. Well, 3 positions because, well, really just 2 because the breaker block and the order block are right next to each other. So 1 position, 2 position, and then there you go. You hold it. And then that's your entry right there. So I might be in this video here because I've been studying IPDA, which is Interbank Price Delivery Algorithms, or aka quarterly shifts, for about let's see, I'll say about probably for past month now, just to make sure I got it. I'm studying, back testing, and here I am back teaching you guys what Interbank Price Delivery Algorithm is. But anyways, enough chatter, enough me yapping about 20-day, 60-day, 40-day ranges, buy side liquidity. And I'll be in this video here. Peace.